President Biden is proposing a massive $2.25 trillion infrastructure plan. And along with the infrastructure are major tax hikes to offset their costs. There hasn't been a significant reaction from the major indices other than we're at all-time highs. But when more details of the plan sink in, will this be a wake-up call for investors? Well, let's take a look. The infrastructure plan, which would take effect in October, is a promise to keep the economy humming through 2022. The plan includes $620 billion in spending on transportation, including roads, bridges, public transit, and electric vehicle incentives. Another $650 billion would be spent on non-transit building efforts, including affordable housing, broadband, the electric grid, and public schools. Biden wants to spend $500 billion on growing the domestic manufacturing sector with a focus on the chip industry, green manufacturing, and research and development. Of course, this is good news to the chip equipment makers. The plan also includes $400 billion toward the in-home care sector, including pay for caregivers. The initial response on Wall Street looks favorable, with the economy in recovery and with corporate earnings expected to surge this year and next year. Most on Wall Street see stocks continuing to rise. But maybe Wall Street is a bit too complacent because we do have tax hikes and rising interest rates to deal with. Biden is calling for a hike in the corporate tax rate from 28% to 21%. That would raise $730 billion, according to the Tax Policy Center. Wall Street also expects Biden to propose hiking the tax rate paid by foreign subsidiaries to 21%, which would raise $440 billion. Keep in mind that the infrastructure spending is just the first part of a bigger tax and spend package. The further proposal is expected to come in the next few weeks and could total more than $4 trillion. To pay for that, top individual income tax rates would likely rise to 39.6% for households earning more than $400,000, raising $110 billion. So anyone here in that tax bracket, please feel free to leave a comment in the video. Long-term capital gains tax is expected to rise from 20% to the regular income tax rate of 39.6% for 1 million earners, raising $370 billion. And anyone in this tax bracket, also, please leave a comment, as well as a few dollars. It's too soon to say how this will all shake out and how the market will react. But this week, Ed Yardeni of Yardeni Research wrote that Biden's corporate tax hike would reduce the S&P 500's earnings per share by $15 to $200 in 2022. And that may be more than Wall Street has priced in. UBS equity strategist Keith Parker wrote that he anticipates a 3.6% hit to earnings per share from the Biden tax plan. Moreover, Parker wrote that hiking the tax rate on long-term capital gains from 20% to 39.6% could slice another 1.5 points off the S&P 500 PE multiple, or another 7%. Again, not much of a reaction from Wall Street yet, so let's take a quick look at the Russell 2000, as I think that is where the first cracks in the market will show up. And so now we're taking a look at the 2-year weekly chart on the iShares Russell 2000 ETF, and this is a proxy for the Russell 2000, and the symbol is IWM. And as you can see here right now, at least from the price chart, it looks like a possible topping process. Now, I'm not quite sure yet. We're still above that 20 EMA. We reflected back up off of that here, and now we're at 220.94. So we do need some time to really see how this is going to evolve. And I'm not saying that the markets are really pricing in Biden's plan yet. There's a long way to go, particularly through Congress. But looking here at volume looks fine. But here into the back, here's your first red flag where the fast line has come through the slow line. Now we're still well elevated above that zero line, so anything can happen, and there's plenty of strength too. So I would imagine that this is going to come down and could easily reflect back up and through the slow line. But time will tell. At least for now, as shown by the histogram, things are taking a dive down below that zero line, but not too far. And into the price rate of change, we pretty much see the same thing, except for the weakness began back here in late February. Moving into the relative strength, we're at a moderate 58.55, and we've been rolling over for now 2.5 months. So a lot of these oscillators are indicating that maybe not necessarily significant problems, but definitely some cautionary signs. You see that here in stochastics, kind of rolling over. The fast line's been on the underside here for 2.5 months. Into the Williams one still is in that positive territory above that midline, but this is coming down pretty quickly and it is almost at the 50 line. We'll see if it gets a reflection back up or if it comes on through. But back up here to the price chart, I don't think that the bell is ringing for everybody to sell yet. And frankly, I wouldn't say sell anyway. Just take this time to position your portfolio properly. I am doing that, and I'll tell you more about it next week. And for today, that's ChewDog Charts. Thank you.